Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of March the 3rd, 2025. Now, to get started this week, we'll begin where we always do with that very important US dollar index. Now, what I had highlighted, well, first and foremost, just for disclosure reasons, this is for educational purposes only. No recommendation is being made to buy or sell currencies, but rather an educational presentation using the VantagePoint software. So when we look at trading going forward, or in last week's trading, a quick review of that, excuse me, we look at the Monday bar very, very closely here. And what I had discussed is a Monday-Tuesday reversal, and then I showed a 9-month, over a 9-month period when the dollar usually becomes strong, but this is a regular occurrence, almost on a monthly basis, other than maybe 2-3 times a month, August, December, possibly November, but usually real dollar buying occurs. So we can see the high and low of the Monday bar. We come in around 105.90 and 106.75. We have a big bull move up on Monday. Then the dollar gets hammered lower on Tuesday. We go sideways on Wednesday, then we break out on Thursday. Now, again, this is an occurrence that happens almost every month here, guys, and it's overlooked by a number of different analysts. They call a bearish dollar when in actual fact it's a bear trap in most cases. So right now, going forward, we have cleared and closed above the T-cross long. But let's make sure we're looking at our main pivot levels. This is why we avoid a rolling performance model. The current monthly opening, the current yearly opening price. So a new monthly opening price we will get on Sunday night, and that's probably going to be somewhere around 107.61. So again, that's going to make it somewhat difficult for the dollar to hold its gains, but in most cases, the US dollar is strong until the week after the Tuesday, usually after the non-farm payroll number, regardless whether that number is very strong or very weak. This is, again, what most miss is that the real dollar buying is occurring right now. So we want to be cautious. We have a short and a medium-term crossover, but our long-term crossover is not really that strong. The neural index is pointing down, the predicted RSI. We've got momentum on the break of the 60 level. But I anticipate, and here is something I will advise again, from an educational standpoint, is I would always allow all markets to come in on Monday and then look at most of your volatility is occurring on the Monday high, the Monday low, and then we transport that over to Tuesday, Wednesday, and Thursday of the rest of the week. And that's exactly what happened with this dollar index this week. Yes, we made a slightly higher than last week, but it had no relevance here, guys, because again, we've got to hold above that high point on Monday to confirm that, which we couldn't. But I can see with a lot of different technical tools that, well, we made a new high, so we're going to go higher. And I've been caught in that same situation many times. And that's why going forward, after years in these financial markets, that I can say, look, wait a minute, what actually happened on Monday? Thin, illiquid markets. We've got a lot of volatility coming in on Monday. Everything is up in arms now between the US and Ukraine. So it's going to be a very, very choppy start to the week. So allow all markets to come in and then Monday evening say, okay, this is what we're dealing with. And then we look at what the volatility was on Monday, the high, the low of Monday, and then apply it to the rest of the week for a breakout. So we patiently wait through Monday, Tuesday, and Wednesday, and then you can see, as I outlined last week, that there is a very high probability, regardless of any headline data, good, bad, or indifferent, that the dollar goes higher. But again, we are still bearish on the year, while below 108.52, and that would be our target. And then the dollar is likely to reverse from that particular area. But we, again, nothing is 100%. But the main thing is know your levels and have price targets. So this move higher in the dollar is not a new trend until we clear 108.52 and stay above 152. But once again, this monthly opening price as of Monday will move considerably lower from 109.28 all the way down to probably around 107.61. Now, with gold prices, I also forewarned everybody that, look, in most cases, gold is going to succumb to that dollar strength. And you can see this actually, I would argue, started right at the beginning of the week, and we were pressuring the VPT cross long. But the second we broke it, again, we had a bigger move to the downside. Now, to be clear, again, we look at the primary trend in gold. It is clearly up. So longs are still favorable while above 2607. We will get again a new monthly opening price, which will come on Sunday night. That is likely going to be somewhere around 28.77. So we will measure whether we can hold above that monthly opening price. I believe gold will move higher in the month of March, but we have to get past the first week and a half at the beginning of the month with that period of known dollar strength. So again, the indicators are right now do look very bearish for gold, but remember, this is a corrective move lower. It's not a new trend until we hold below the monthly opening price of March, and or to put it more bluntly or clearly, for a new trend to form, we would actually have to turn negative on the year and go below 2607. So buying on a dip is absolutely favorable here, guys. But you can see how many people get caught in this bull trap at almost the exact same time every month. And it's a lot of that has to do with that period of known US dollar strength. So again, these indicators, the neural index strength, the predicted RSI, they're starting to flatten out a little bit. So I think gold should potentially recover by as early as the end of this coming week. Now, the stock market's again on the inflation data, but this is another very, very powerful example of using the current yearly opening price. Last week, we came down and hit this thing 3 times, but ultimately we managed to close somewhat higher, 59.59. So we're watching the level of 59.03 very, very closely, the current yearly opening price. Now, again, the reason I stress this, guys, is with our predictive indicators, the powerful tools in the VantagePoint software, we want to also apply something as simplistic is to determine what the real trend is. So for now, the trend on the S&P 500 and gold still remains up. The primary trend on the dollar still remains down until these levels are broken. Now, right now, I can see an MA diff cross attempting to form here, so we'll keep a very close eye on this. But for now, 59.03 on the S&P 500 is very, very important. Now, when I do a comparative analysis to my European friends, the DAX has actually held up far better. Now, in the VantagePoint Live training room, which we do this 3 times a week, I had discussed this at length on Monday that I actually like the DAX better than the S&P 500 right now because of the price structure. We're firmly above the monthly opening price, not even coming close to testing the yearly opening price. So this can tell us one of two things. The DAX has room to extend higher, or the DAX is lagging behind the positive correlation it has to the S&P 500. So these two things, we need to decipher which one is the likely winner. Well, in my respectful opinion only, that when the dollar moves lower a week from this coming Tuesday, then all of these equity markets could turn higher. But there is a lot of macro global economics here that are at play that could change things. Trump, the Ukraine, Russia, there's a lot of things happening here, guys, that could really send equities lower. But again, they have held up quite well. The predicted differences on the DAX here, they're still fighting it out right along the 0 line. Predicted RSI running flat, but above 50. Neural index is giving a caution, but still pointing up. But the main thing here is our T-cross long, 22,251. If we're holding above that, we still have a long trade available here, but I do believe that the DAX could come under a little bit of pressure this coming week. So we would do a comparative to that with the VIX. We look at the VIX and say, okay, once again, I had warned everybody last week that if we're holding above the current calendar yearly opening price at 1771, then stocks are going to be in trouble. So what I'm also saying here now, that I believe that the sell-off in stocks was be careful of a bear trap. We've seen this movie before many times, and all too often, after a big sell-off, it turns around and moves higher. But this last week in February, historically, over the last 5 years, has been very, very volatile for stocks, for Bitcoin, for the dollar, for gold, all of these markets. But now we're done with February, we're moving into March. So we don't want to succumb to that rolling performance model of the last 5 days. Well, the last 10 days, that would take us back into February. We're not trading in February, guys. We're trading in March. We want to look forward, not backwards, right? So I believe the VIX is going to struggle this coming week and that the stocks can recover. I can see an MA diff cross trying to form here. So I'll watch it very closely. But once again, when I look at the global equity markets, I've been very impressed with how the European equities, more specifically the DAX, to help out my friends in Germany, this has been doing very well. But this tiff between the Ukraine and the US now could put a lot of pressure on the German stocks this coming week. So we'll see how it plays out. But there are signs that the VIX is weakening. Now, light sweet crude oil, commodities in general, is taking a hit last week. We've got a firm, what appears to be a decent bottom here on oil. That's coming in a low of 68.36. The indicators here, this is a very clear buy signal that is forming on oil. Now, it may only be corrective. The pink line over the blue line, that tells me at the very minimum, we're going back to the yearly opening price, 70.92, and potentially the T-cross long at 71.20. I believe that to be very, very likely. And oil usually does respond positively to a stronger US dollar. So if we continue with a little bit of dollar strength, at least for another week, then that should help out your oil longs. Again, but remember, we're below the yearly opening price. We need to clear 70.92 sooner rather than later. Now with Bitcoin, again, when we look at Bitcoin historically over the last 5 years, the last week in February has been very, very volatile, and there was a substantial sell-off. It didn't disappoint. It did it again. But again, in my respectful opinion, a buy signal is forming again. When we look at the neural index versus the neural index, the base neural index versus the neural index strength, you can see it showing two very different signals here. So I would respectfully submit we put a line at the lower end of this at 78,589. So if we get a big drop on Monday in Bitcoin, that's likely it, guys. And then we start to turn higher for March. So I'll leave it at that. The indicators in VantagePoint are slightly in agreement with what I just said. They're not 100% yet, but there is a buy signal forming there. That is the best advice I can give you from an educational standpoint or in a historical standpoint, what it has done in the last week of February versus the month of March. They've been very, very different price action. So we always want to make sure we're adding a touch of seasonality to anything we trade. Now, as we look at some of our main Forex pairs, once again, the Monday-Tuesday reversal can apply to a lot of different markets here. So we see something very similar. We're down on Monday on the euro, or excuse me, we're up on Monday on the euro. Then on Tuesday, we turn around and move down. So again, down Monday, up Tuesday. But then you can see a more ominous signal starting to form here on Wednesday of last week. Now, where we're at right now, 103.70, the calendar yearly opening price, this is very, very important to layer that in on top of whatever trading strategy you're using. VantagePoint, other strategies, but this focuses on the VP indicators. So again, I think we have more downside in the euro. So the previous monthly opening price was 103.30, but if we look at this and if I'm to guesstimate what the opening price of the euro is, we could see a gap. But the closing price, 103.76, that's where your opening price is likely going to be. So again, I do anticipate the euro to come under some selling pressure this week. The question is, how long will that last for? And the geopolitical issues right now, how much will that weigh on it? The main thing is, guys, just know your levels. This is going to be a very interesting month because the monthly opening price and the yearly opening price, I suspect, will be at almost the exact same level. So to simplify this, while below it short, while above it long, but we have to make sure we watch the closing price each day. Are we closing above the yearly or below the yearly and the monthly, combining those two? So all of your area, all the bulls and the bears, where they're going to fight it out this coming week is going to be right around 103.76. And we go to our core VP indicators to guide us to see which one is actually winning here. So again, be very, very cautious with this pair next week. Same as the US Swiss franc, it mirrors the dollar index. The dollar index recovers, so does the US Swiss franc, but they're both under the calendar yearly opening price, 90.63. I believe we can clear that area because I believe in the VP indicators to be accurate. The MA diff cross, the neural index, the neural index strength, in this case, they're both in agreement. But we need some momentum here, guys. We're at 59.7. We break above 60 on the predicted RSI. That's the momentum we're looking for. If we can get that, we go higher. Okay, so again, the T-cross long, 90.19. We closed just above that at 90.30. That's the one we're looking for. My only concern, which I will stress here from an educational standpoint and an intermarket analysis standpoint, that if those equities continue to move lower, that will actually strengthen not only the dollar, but it will also strengthen the Swiss franc. So be careful with that, with this particular pair. The euro could still go lower. It doesn't necessarily mean that US Swiss franc will go higher. So just pointing that out. But again, if we know our levels, 90.63 is a significant hurdle for this pair to get above next week. But if it can get above it, then we have at least for a week, we have some decent long trades on this, probably to again about Thursday, where we'll see profit taking, because there's two things that I provide. One of the main things I provide for the VP live training room is the Monday, Tuesday reversal, but also there's another reversal that occurs, and it's always on Thursday. And that's profit taking in the Forex market, in the commodity markets, and it can send price reeling in the opposite direction from what it's done the entire week, just to point that out. Now, the British pound US dollar, once again, had I would argue, a very good week here until Wednesday. And then on Thursday, it succumbed to the dollar strength, which we were way out in front of. And again, nothing is 100%. I can basically guesstimate when something is going to turn based on patterns that I've seen in these markets over the last 25, 30 years. And that's the main thing, is these repetitive patterns that occur that your new and old traders alike fall prey to. So I try and point that out to say, oh, be careful. You may not look the way you think it does. And again, it's never about being right or wrong with me. It's only providing information that the other media pundits are not providing. So again, the T-cross long, I suspect it will give way. 125.64, but 125.13, the yearly opening price, be very cautious around this area. I think it initially will break, but then I also think there's a chance it could recover going into the end of the week. But that payroll number on Friday is going to be a big one. Is the Fed going to cut? Yes or no? That payroll number would be a deciding factor going forward. But the position of the predicted RSI at 36.8 is actually not oversold, guys. That's a myth. What it is it's showing momentum to the downside is actually building. A conventional RSI has a 70-30. Some people use 80-20, 80 overbought, 20 oversold. I'm not interested in trading overbought and oversold signals, guys. I'm interested in trading flow, market flow. I want to go with the flow of the market. I don't want to fight it. So if I'm saying that something is oversold and I should buy it when everything else is bearish, that's a problem. So I split it. Use a 60-40 split, and when I break 40, that's actually a strong sell, is what it is. So that's the best I can. So again, I think we just want to be very cautious with this pair, but I do anticipate it can break down below 125.13. It's a question of how long it can stay below that particular area, and that is probably as an expiry date of about maybe a week and a half. So be careful with this one, but at the current time, we know where our levels are, and the yearly opening 125.13, T-cross long 125.64. If we're holding below that, we know that at least in the near term, being this only a weekly outlook, that the bias would be down. Now, with the dollar yen remains under pressure here. It's trying to recover, but you can see that we're heavily down on the year. 157.28 the beginning of the year. The indicators right now are bullish on dollar yen. But again, it's a high-risk long trade. In my respectful opinion only, it's still the yen is grossly undervalued here after the COVID, the Fed hikes, the Bank of Japan cut, but that dynamic is starting to change, which will change the carry trade. So for now, our key level here, our T-cross long, 151.30, we would have to make a clean break of that to even consider longs here. And we still have to deal with the fact that we're very, very negative on the year. But if the Fed holds his ground and says he's not going to cut, then that would push this pair higher. So as long as you know your levels and the risks that are involved, there is still possibly a trade there. Now, the US-Canadian pair, once again, not a chance of a Monday-Tuesday reversal here with the, Trump reinforcing the tariffs against Canada. Now, this is why I'm saying next week is going to be very, very volatile. I believe it's March the 4th. Either he's putting these tariffs on or he's not, but he's got to make a decision and stick to it. Each week or at the end of the month, each extension, this volatility increases. So I imagine the Canadian dollar will come under further pressure, but if Trump says, okay, no tariffs, then this thing will drop like a wet bag of cement here. So it's going to be very choppy and volatile every way, no matter which way you're trading this one. So in my respectful opinion only, I would advise wait until we see if we're getting these tariffs. But if Trump is hinting that there aren't going to be tariffs against Canada, then there would be a powerful short. And again, there's the same bar from last month, and you can see the high and low of that is 147.93 to 143.90. That is a big, big move for this particular pair that moves on average about 40 to 80 pips a day. So that's a lot of choppiness around this tariff stuff, and that's what you're facing on Monday, because if they're either going to go or they're not on Tuesday. So expect a very, very volatile start. But the US-Canadian pair managed to clear the yearly opening price. It will stay above it if those tariffs come on. That would be detrimental to the Canadian dollar. But if there is no tariffs or even an extension, we will be right back below that yearly opening price very, very quickly. The Aussie and the Kiwi, basically, I would argue we're following, to some degree, the CAD. The CAD, the Aussie, and the New Zealand. Very similar currencies. So right now, the Aussie is in an interesting position. The calendar yearly opening price there is 61.89, but a mixed indicator set here. The predicted differences are down, but the neural index and the neural index strength, the neural index is down, excuse me, it being red. The neural index strength is saying there's a bit of life here. So the line in the sand for this week is 61.89. And again, right now, it's still a corrective move lower unless we close below that. And I'm going to argue for 2 or 3 days in a row. And what I like to see is it close below the yearly opening price, retrace back up to it, and then fail again. The same thing this week will apply to the Kiwi. It's the same trade, guys. And you can see they're pressuring the same level. The calendar yearly opening price, 56.02. Most of the indicators are bearish. But again, here's my view. And from an educational standpoint, in most cases, the dollar strength is done the Tuesday after the non-farm payroll number. If that payroll number is weak again this coming Friday, that dollar weakness will kick in right away on Friday. But in my respectful opinion, either way, the dollar weakens after about the 10th of the month. So with that said, this is the VantagePoint AI Market Outlook for the week of March the 3rd, 2025.